Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
This week on Wall Street Wrap-Up, Hurricane Ian slams into the Florida Gulf Coast just below Tampa as a Cat 4 hurricane, causing massive damage to Florida as it now enters South Carolina. And the Commerce Department today releasing new data of core PCE. Stocks sink as Wall Street ends on another down week, month, and quarter. And what's in store for October and for the fourth quarter? Is there much more pain to come in the markets? Tonight, we're going to be talking with the chief market strategist at Crossmark Global's Victoria Fernandez. You know, there's an old saying, never try to catch a falling knife. Or is this a great time to buy when there's been so much of a sell-off? Victoria Fernandez will be here to help us sort through all of these questions. I'm Andre Laborde. It's Friday. That means it's time for Wall Street Wrap-Up. Hi, I'm Andre Laborde, and welcome to Wall Street Wrap-Up on this Friday, September 30th, 2022. I hope your week went well. We've got a great show this evening, so let's get to it. Well, today was the last day of the trading day for the week, for the month, and the last day of the third quarter. Now, we'll start the show off with some good news. September's over, thank goodness. The Dow Jones ended its worst month since March of 2020, and its worst September in 20 years. The new data released today said that inflation accelerated more than was thought for August. The core PCE, which is the personal consumption expenditures, was released by the Commerce Department for August, and it rose 0.6% in August after being flat in July. For the month, both the Dow Jones and the S&P were both down over 8%, and the NASDAQ, they dropped over 10%. It was the worst drop for the Dow Jones since 2002, for the S&P, worst since 2008, and for the NASDAQ, also since 2008 as well. Well, Hurricane Ian slammed into the Florida Gulf Coast this week, causing billions in property damage and, worst of all, loss of life. According to Governor Ron DeSantis of Florida, it was the fifth strongest storm in the U.S. history. And this week, what seems like sabotage occurred when the Nord Stream 2 pipeline, which is owned by Russia and recently completed, that bypassed Ukraine to send oil from Russia to Europe, had parts of it destroyed by undersea explosions. Marko Kolanovic from J.P. Morgan said the destruction of the Nord Stream 2 pipelines increased tail risks and makes it difficult to de-escalate near term, and many believe that the current situation is similar to the Cuban Missile Crisis back from October of 1962. Well, how did the markets do this week? The Dow Jones, the S&P, and the NASDAQ all closed lower. All 11 S&P sectors also closed lower for September. And this week, the Dow Jones ended at 28,730, which was down 2.8% for the week. The S&P 500, they closed at 3586, which was also down 2.8% for the week. And the NASDAQ, they ended at 10,575, down to a little over 2.5% for the week. Let's get to our guest this evening and possibly help sort us through the carnage with the chief market strategist at Crossmark Global Investments, Victoria Fernandez. Hi, Victoria. Welcome to Wall Street Wrap-Up.
Thanks for having me. It's a pleasure to be here.
Victoria, the way the market's been in the last few weeks, do you think that it has much more lower to go as far as dropping? Do you think it has a little bit more to go? What are your thoughts on it?
Yeah, it's a great question, and it's one that I don't think any of us can truly answer with 100% certainty, and I think that's part of why we're seeing such volatility right now in the markets. Obviously, this week, the S&P closed below its June lows, so there's a lot of technical elements that start to come into play. You have retracement levels on where people think the market can. You've got lines, you've got all of the internals of the market. We had to do a best guess based on what we're seeing. We do think with continued volatility, we'll see the stock market move a little bit lower. Are we getting closer to that bottom? We think we are, but there's still some elements in the market that you typically are waiting to see for a bottom, and we haven't seen them yet. So looking at the levels of the VIX, although they're moving higher, they're not quite where we want them to be. Real earnings yields are still negative. Normally, they're not negative when you hit the bottom. So there's just a few things that we're waiting on. So I think we have maybe a little bit lower to go.
Two things that happened this past week in the market that I'm curious your thoughts on. Hurricane Ian slams into Florida, and it looks like it's going to be going up the eastern seaboard and going back in to the central United States. That's one. And another area is the Bank of England. They had problems with their bonds that it shows that probably we are globally joined at the hip when it comes to the stock market. Do you think any of those two areas, whether the hurricane or the problems with England?
So I'm going to start with the Bank of England because I think that's probably having a much more outsized effect on what we're seeing in the marketplace. I mean, you have a country, and like you said, we are not on an island by ourselves. We are all connected. And you have this country that's had extremely high inflation. Their economy has been suffering, and they get a new budget plan coming out that actually puts more stimulus, which means there's probably going to be more inflation for them. And so that's what started a lot of the issues we saw in the UK over the last week. Then you had the Bank of England come out and say, well, we'll start buying bonds because structurally they need to have some calmness in their markets. And so they went in and they wanted to start buying bonds. You know, it's interesting. You saw gilt yields move about 150 basis points higher over the last week and a half. And then overnight, after the Bank of England said they were going to start buying bonds, you saw yields drop tremendously. And I think that fed through to some of the drop in yields that we saw in the middle of this past week here in the U.S., where we saw yields come back down in the U.S. from about 4% on the 10-year Treasury back to around a set time. So I definitely think there is some effect from the Bank of England. And then you look at the hurricane. Obviously, I live in Houston. I'm in the Gulf Coast. We hate to deal with hurricanes, but it's that time of year. If you have the hurricane hitting more in the Gulf Coast, then I think you'd maybe see more effect on some of the oil stocks and the energy stocks because it's hitting closer to Florida. Maybe there's not as much effect on those sectors and those stocks than you would otherwise. But obviously, insurance companies, anyone that has any kind of effect in regards to helping these people recover from the storm, especially when it's looking, you know, it was a Category 4, Category 5 storm, you'll probably see a little bit of ramifications coming in the insurance sector.
We're in the last day now of the third quarter, and we're going into the fourth quarter now. Do you think that because of Ian, Hurricane Ian being a Cat 4, and then going up the eastern seaboard and then going back into the United States the way they are predicting it, do you think that will have much effect on the earnings of the fourth quarter? Because that's at the very beginning of the fourth quarter, and we've got the holiday season at the very end of the fourth quarter. So I'm curious your thoughts on that.
Yeah, so you kind of have a push and pull going on right there. Obviously, the negative effects of the hurricane coming through, and for the entire eastern seaboard in a storm that is that large, we know there can be tremendous effects. We've seen it in Texas. We saw it from Harvey, which wasn't even a hurricane at the time, that the effects that it can have on certain parts of the country and how that flows through. So I wouldn't be surprised if we see a little bit of effects, and we won't see it in the earnings that are about to start being reported. We might see it in the earnings going into the beginning of next year for the fourth quarter. But as you mentioned, this is a quarter that has very strong seasonality associated with it because of the holidays. And a lot of the support in this market has come from the consumer. And maybe how that consumer on the eastern seaboard, if they are tremendously affected by the hurricane, that could affect spending in the fourth quarter.
This week, DocuSign is laying off about 9% of their workforce. Snap, we heard last week, was laying off about 20%. We've had a number of companies either pulling back job offers or doing job cuts. And we've also got for August, because we haven't gotten September's yet, the labor participation rate is around 62.4%. Well, that means about maybe 37% of the of the workers that could be eligible for work are just not working. So I wonder, how strong do you think the consumer is in going into the fourth quarter?
Household balance sheets are actually quite strong from a historical basis. We know that there was, extra income through the stimulus programs that happened over the last year and a half that helped some balance sheets initially. A lot of that has run off. Some of it went into savings. But we look at that labor market that you're talking about, Andre, and it's so strong right now. And the participation rate, there's plenty of room for people that want to come into the labor market. They can. So you figure if their household balance sheets are really struggling and they need that income, there is an opportunity to go into the labor force and to get that job. You look at job openings, what we call that JOLTS report, job openings and the leavings from certain jobs. That still is telling us there is such strength when it comes to labor. Wages continue to move higher on a nominal basis. And so to me, I think the consumer continues to have some strength. Are they as strong as they were previously? Maybe not, but they kind of have the advantage when it comes to the labor market, when it comes to wages. We're seeing people leave jobs and go get other jobs to make more money. That has slowed down a little bit, but I think the consumer stands pretty strong. And when you look at credit, it still is less than 10% of income, their credit balances. And so historically, that's a good place for them to be. To me, that means I think we'll see some solid spending in the fourth quarter. Analysts are saying maybe up 5 or 6% from what we saw last year.
Do you think that we are in a recession now, or that we'll be going into a recession?
It's that magic question that people want to know.
Nobody
are we
knows.
already in a recession, but we just won't be told that we are until a few months down the road? I don't think we're in a recession per se right now, the typical recession. You have a lot of people saying we're in a growth recession. So we've seen growth slow down tremendously. You have the Atlanta GDP Now number saying that GDP for this quarter will probably be about 0.3%. So it's slightly positive, which means we wouldn't be in a recession. But I think we'll probably see more elements of a recession coming next year, maybe towards the end of the first half of next year, as all of these rate hikes that we have seen from the Federal Reserve and other central banks, as the effects of that really flow through the economy. It takes 6-9 months for that to happen. And you don't see the Federal Reserve saying right now, we're going to slow down and just take a break and let some of these effects flow through. They're not saying that. They're continuing to go full throttle. So I think we will see more signs of a recession, more probability of a recession in the beginning of next year or the middle of next year.
And that's a very good point, Victoria, because this week, Richard Clarida, who was former vice chair of the Federal Reserve, he was saying that he probably is figuring that the Federal Reserve will do another 75 basis points in November and probably 50 in December. And then January, he didn't say how much, but in January, another hike and then pause.
Yeah, I think he's probably right with a lot of that. The 75 basis points in November and the 50 in December is what's priced into the market right now. I think that's what people are anticipating. Obviously, as we get more economic reports, as we see more information from the labor market, as we see more information on the inflation numbers, that could change. But that's what's priced in right now, which gets us to a Fed funds rate of north of 4%. 4.25%. And that's what a lot of members of the Federal Reserve are saying is going to be that terminal rate. So, yes, I think by the end of this year, we could be close to the terminal rate or do another maybe 25 basis points at the beginning of next year and get us there. And then we are in that restrictive phase that Chairman Powell has talked so much about of where he wants to be. And I think we'll see a pause. They're going to need to do it at some point and allow these effects to flow through. Otherwise, I think it will be more of that hard landing recession that people are talking about if they don't take a brief pause and see the effects of what they've done so far.
Do you think some of it has to do with the psychological effect that they used the word transitory for so long, and they were buying bonds for so long and just dumping money into the economy? And that was in addition to, the spending of Washington, D.C. But between Washington, D.C. spending so much and also the Federal Reserve zero interest rates for so long and buying bonds, that they now want to try to regain their mojo back to being able to go, no, we mean what we say?
That's a good way to put it. I would say that along those lines, especially when it comes to this past summer, when the whole concept of transitory was brought by the Federal Reserve and they really stuck to that story, I think they lost a lot of credibility with the markets and with investors in general. And they're trying to gain some of that back. I mean, look, when the terminology was first used in order to talk about inflation, I was totally on board with the idea of most of what we were seeing being transitory. Supply chain effects because of COVID, people not working, but yet getting stimulus checks. And so there was too much money for too few goods. And we know that's the story of inflation. And so I was going along with that story for a while, but I do think that they took it too long. And therefore, some of the repercussions of that zero interest rate, of the stimulus payments, of too much money chasing too few goods has got them to the point that they're at now. And they want to make sure that they don't make the mistake of what we've seen in previous decades of starting to raise rates, then stopping and then saying, oops, that wasn't quite enough. Let's go back and raise again. They want to go all the way as far as they need to go, stop, wait, and then the next move would actually be down instead of back up. We'll see if their plan works. What we don't want them to do is move so far, so fast that they do send us over the cliff into a hard recession.
You know, Victoria, it's a lot like a lot of things about life. You know, a little bit of something is good, but when you go overboard on something, I don't care whether you're talking about dessert or anything. just a small quantity is right. Do you think the Federal Reserve... Moderate. Thank you. Thank you. So you're absolutely right. Moderation. Do you think the Federal Reserve is more worried about recession, or do you think they're more worried about inflation?
Oh, I think this is an easy one. I think they are completely focused on inflation at this point. And they've even told you that, right? Chair Powell has come out and told you multiple times, look, there's going to be pain. That's the word he used, right? There's going to be pain for the people in this country, pain for the economy, for the markets, but their focus is to get inflation back to 2%. They're even saying, you know, we're willing to let the labor market have some issues in order to get inflation back to our target. And it's interesting, you know, we're talking about the Federal Reserve not wanting to take a pause, but they also have not wavered at all from saying that their target on inflation is 2%. We actually had discussions in our investment committee saying, I wonder if they would transition a little bit and say, look, okay, our target maybe is going to be 3%. If we can get inflation back down to 3 to 4% in the near term, would we be happy with that? Would the Federal Reserve say that's good enough for now and take their foot off the gas? We haven't heard that from them. And so I think they're much more focused on the inflation component. But what we've seen in the markets as of late, I think, is a shift from inflation to recession concerns, which is why we had such the big pullback that we've seen recently.
At Crossmark Global, do you have both institutional investors as well as individual investors?
No, we actually have both. We serve a wide range of clients, from the individual investor to the institutional investors. And so really, the bottom line is they all want the same thing. They all want their portfolios to grow, but they have different goals in mind when it comes down to specifics.
You know, Victoria, I am so glad you brought that up, because that was exactly the question. What you just answered, what I was going to ask, is that how are they alike? And I'm just curious, though, in addition to how they're alike, wanting a rate of return, a rate on their investment of growing. But I'm curious, do you find that one has their differences also? Do you find more problems or calls coming in from the institutional investors going, why are you doing this or why are you not doing that? Or more from the individual investors?
Yeah, I mean, it's a different perspective for the two different types of clients. A lot of institutional investors sometimes will have boards, or they will have other advisors that are working on their behalf and maybe have a deeper understanding of some of the intricacies of the market, or have done more due diligence on us at Crossmark and how we manage portfolios. So we may not get quite as many calls from the institutional side as from the retail side, where maybe people are getting a lot more headline news coming at them and wondering how that affects their portfolio. I mean, we're on calls as portfolio managers. We are on calls every week.
If you're just joining us, we're so happy to have Victoria Fernandez. She's the Chief Market Strategist at Crossmark Global. We're going to take a break. Don't go away. We'll be right back. We're talking with Victoria Fernandez. She's the Chief Market Strategist at Crossmark Global. Through carnage and wreckage, you can find some good gold nuggets. Is this the time right now that you would advise to be able to pick out some good stocks that through this problem of droppage?
Yes, so Andre, one of the things we always tell our clients is you don't want to chase the market. And I feel like that's what a lot of investors do. They see the headlines, they go, oh no, let me react to what we're seeing. If things are looking poorly, then they feel like they have to sell. If things are on the way up, they feel like that's their chance to buy. What we're here to do is try to help them see the intricacies within that. So we think as the market has come down, we talked a little bit earlier about how we think maybe there's a little bit more to go. Maybe we're not quite at the bottom yet, but we're not here to perfectly time when that bottom is. We're here to help find opportunities for our clients. So I do think you can go in as the market comes down. Now, you don't have to jump in with both feet. You don't have to make an all or nothing decision. But I think if you have cash on the sidelines, you have an opportunity to go in and start buying some stocks or some bonds that make sense for your portfolio. And we've been doing that lately. With the last week and with the downside that we saw in the market, we started adding what we call a little bit more beta to the portfolio. We started adding some cyclical names that we think will do well once we hit the bottom and the market starts to rebound a little bit. And some of those would be maybe the credit card names like a Visa or a MasterCard. We've done it with UPS. We think UPS is a great company. They have solid balance sheets. We have good dividend payers. And we really focus on quality of earnings, quality of management teams. These are things we like in our companies we choose. And so UPS is another example of a name that we've added recently.
Are there other type of metrics that you use as a checkoff before you decide I'm going to pull the trigger on this stock?
So, a lot of people want to just throw a dart at the dartboard, but we put a lot of work into how we choose our securities. We look at the management teams and the tenure of those management teams to see, kind of how they would be on a values-based score component, what their governance issues are like. There's all sorts of elements that go in to that model that we have. And then we have our own internal research that takes what the model gives us, looks at what's going on in the market environment, and helps to determine what will be the best fit for the portfolios.
How long are you willing to work and wait at Crossmark, and maybe even for your portfolios for you individually? When you go through that metric and say, okay, this is a stock that I'm looking at, I want to go ahead and pull the trigger on. How long are you willing to wait until you start seeing an ROI, a return on investments?
So we are longer term investors, but that doesn't mean that we are not tactical on a daily basis when we see opportunities. So we're not going to go in and buy something one day and say, oh my goodness, over the next day, it didn't do what I thought it would do. Let's pull it out of the portfolio. But what our models help us determine are the trends that we're seeing in certain names, in certain sectors. It lets us know what we can probably expect going forward. So we take those models, we take the trends that are generated from that, and we look and see if we think there's still opportunity going forward. So there's not a specific deadline that we're looking at for a particular stock. It's every day feeding these stocks through our models to determine if they are still in the top quintiles of what we're looking at in regards to names we want to put in, or if they have fallen into the lower quintiles.
What would you say is more of the common mistakes that the public makes when thinking about buying a stock
a lot of that over the last year, and especially during COVID, is reacting to headlines. We spoke a little bit earlier about not chasing the market, and that's so important for our clients to understand that we are not reacting to a headline that we're seeing on TV. We're not reacting to a soundbite that someone has said, a CEO might have said. We're really looking deep into the weeds on these companies. We're looking at their balance sheets. We're looking at the fundamentals, and we're seeing which stocks are behaving the way that we think is opportunistic. And that's how we're going in and building out the portfolios. So we don't want clients to get nervous from headlines and make a quick mistake, because we know that can be a whiplash really quickly and turn on you. The headline can change the next day. That was so evident during COVID, where you would get one headline and people would go in and buy a whole sector, and the next day the headline would reverse and those stocks would fall. So I think that's what we want to make clients understand, is we're investing with a process for a longer term investment. That's what you need to focus on, not headlines.
Victoria, it's been a lot of fun. Unfortunately, my time is up. I hope you come back.
It was my pleasure. Happy to come back anytime.
Thanks, Victoria. Well, if you have a question about finance or a comment about the show, we would love to hear from you. Make it pithy, make it concise, and write us at andre@wallstreetwrapup.info. And now for a look ahead for market information for next week. But first, it was on this day, September 30th, 1916, who became the first billionaire. We've got the answer in just a moment. Well, on this day in 1916, who became the first billionaire? John D. Rockefeller, founder of Standard Oil, which later became Exxon, Chevron, Mobil, and Amoco. Well, I started the show by having some good news that September's finally over, thank goodness. Well, let's end the show on some good news as well. According to Ryan Dietrich at Carson Investment Group, there have been 7 times, including this year, where the S&P 500 has dropped more than 8% for the month. And all these times, except in 2008, the index roared back, sometimes a lot, sometimes a little bit, but it did come back with a median return of 7% the following month in October. Now, in 1974, after dropping 12% for September, it came back 16%. And the latest was in 2011, when it came back 11% in October. Now, the one time was during the real estate and subprime crisis of 2008. Now, does that mean it'll happen this year? Well, no one really knows. But as the saying goes, the trend is your friend. Well, this week, the monthly Consumer Confidence Survey came out by the U.S. Conference Board on consumers' attitudes and expectations. Well, next week, we're going to be talking with the president of the U.S. Conference Board, Steve Odland. And we'll talk about the health of the consumer during these inflationary times. Plus, how's the state of business and business owners with employment shortages, supply chain disruptions, government red tape, and much more. That's next week. The president of the U.S. Conference Board, Steve Odland. Well, as a reminder, we repeat the show on Sunday mornings, but the best way? Set your DVR so you'll never miss an episode. And that's our show for this Friday, September 30th, 2022. I hope you enjoyed it. My thanks to Victoria Fernandez for joining us this evening. But as always, it's you. We appreciate you for allowing us into your homes tonight. So remember, follow us on all the social media, on Facebook and YouTube and Twitter, and WYES.org. So enjoy your weekend. Have a productive week as well. I'll see you next week. And remember, if it's Friday, it's Wall Street Wrap Up. I'm Andre Laborde. Remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.